The number has come in at 3.58%. So that's a tad higher than what Ekta had got. 3.58% is the combined inflation for October, and that compares with 3.28 in September. So there's no revision in that. And 4.20, of course, was the year ago number. Food inflation has come in at 1.90. So that's higher than the 1.25 that was recorded last month. So it's to some extent perhaps food inflation driven. Those are the two big numbers that we are getting at this point. Okay, now I can give you perhaps all the numbers. Here they are. Cereals 3.6, meat and fish 3%, 3.1. Eggs is 0.6, milk and milk products 4.3, oils and fats 1%, fruit is 5%, 5.05, vegetables 7.47. So there was that spike in veggies that we could see. Pulses still lower from year ago levels, minus 23. Sugar is 6.75, spices minus 2. Then let's go to prepared meals. Prepared meals is 4.96, and that's important to note because we will ask our economists how much that might fall after the GST rate cuts. Food and beverages together is 2.26, but food alone is 1.9, as we told you. Clothing has come at 4.8, footwear at 3.87. Then we come to housing. That spiked, and that was expected, the HRA effect. That's at 6.68. Fuel and light together is at 6.36. So there again, the fuel impact is also seen. Now we come to household goods and services. That comes at 4.05. Again, remember the number 4.05, household goods and services could fall next month because of the GST impact. That, of course, is only half the month of November, but still a lot of household goods and services have seen a lower GST rate. Health has come in at 4.12, transport and communication 2.26, again will be impacted as the crude price impact gains ground. Recreation 3.89, education 4.15, personal care and effects at 3.36. So what we have is services inflation at 3.48, general index, as we told you, is 3.58, and food index at 1.9. Okay, first thoughts, Tushar?
Well, I think it's we had penciled in a reading of 3.45, so it is close to our and market's expectations. I think the important point is that it reaffirms our view that inflation will be somewhat lower than what the RBI had projected in its last monetary policy meeting. It also raises to a certain degree a question whether that change in inflation estimate from the RBI was a bit premature or not. I think it was a bit premature. I don't see inflation heading above 4% unless until January, February of this year. Even if there is a breach, I don't see a breach more than 20 or 30 basis point more than 4%. So it has come in a bit different, what RBI had projected in, and it raises some questions about their inflation forecast.
Okay, well, Mr. D.K. Joshi, Chief Economist at CRISIL, is with us as well. Mr. Joshi, what is your sense in terms of, say, the food inflation trajectory from here on?
Well, I think food inflation has mixed trends. I think on one hand, there is a low base effect, which is pushing the inflation up. But if you look at the categories of food items, I think things like pulses, etc., there is a glut, and I think many crops are selling below their minimum support prices. So that means that there's not much upside. I mean, food inflation will go up, but I don't see it spiking. To me, the major risk is from the fuel side. If the recovery in crude prices is sharp and is sustained, I think these are the two conditions. Just remember that a few months back, nobody was predicting the crude prices to rise so sharply. So it is political event driven. It could again correct itself. But if it is sustained, then yeah, we have a pressure building up from that side. And on the GST, what creates confusion is the GST, because I think typically what happens is when there is an asymmetry in the pass-through, when the prices, when the tax rates are reduced, they typically don't get passed on so quickly. But when they are raised, they get passed on very quickly. And this is actually has been the experience across the world. So I mean, how much pass-through will be there? I think it all depends on that. So I think that's a very, I mean, that's something which is very dynamic, and that even the tax rates are getting changed. But overall, I think looks like new GST rates will exert somewhat downward pressure on inflation, particularly.
What is your subsequent 4-month numbers? Is there a 4 handle? Where are we in March, Mr. Joshi?
Well, I think we do an average yearly forecast, and I think that is at we are forecasting average at 4%, which means 4 to 4.5% towards in the last quarter.
Okay. That is the Reserve Bank's forecast as well, and they are also around, I think, 4.25 thereabouts. Sajid, how would you draw the inflation trajectory from here? Give us your current estimate of November, December, Jan, Feb. March.
I'm a little more concerned about some of the upside risks here, Lata. If you look at today's number, we don't have the exact disaggregated data, but from what you mentioned, the core number, which is ex-food and fuel, is stuck at 4.6%. We had thought it would moderate a little bit the year on year, so that's at 4.6%. And what you're seeing is kind of a worrying acceleration of some vegetable prices in the month of November. Now, typically in November and December, prices come down. I'm sure some of this will be reversed next month, but for what it's worth, some food prices have gone up in November. And number 3, oil is still not in the price. If you look at how much OMCs have raised prices the last month, basically diesel and petrol prices have gone up about 2.5%, whereas they should have gone up somewhere between 8 and 10%. So at some point, either excise duties will need to be cut again, or you'll get a discrete adjustment in petrol and diesel prices. So I want to clarify, before the GST cuts on Friday night, at least our inflation trajectory was that in November, inflation is comfortably above 4.5%. There's a step jump up given where food prices are. And Jan, Feb, March, you're somewhere between 4.8 and 5%. This is assuming oil prices remain at current levels, around $60 a barrel. So we actually think that the risk here could be to the upside. Now, how much the GST impacts this on the downside, as DK correctly mentioned, there's a lot of asymmetry in pricing power. Let's not jump the gun. We actually saw that the first time around. Tax increases were passed on instantaneously. Tax cuts were not. So we'll be agnostic about that. But you have to subtract that from the 4.8 to 5% that we see inflation in the first quarter of 2018.
That's serious. Suppose you remove the one-off of housing, HRA, which strictly is one-off, then where would you land? Because the monetary policy statement did give, if I look through HRA.
It's about 42 basis points in the central HRA. So your range would then become, 4.4 to 4.6 is where you are assuming where oil is right now. And this builds in a substantial mean reversion of some of these food price increases that you witnessed in October and November. The expectation is that when the crop hits the market, December, Jan, February, a lot of this is reversed.
Okay. Tushar, what do you think the RBI is probably going to do now in any case? Because this number becomes redundant. But in any case, what's your expectation?
I think RBI highlighted the risk for oil prices. I think that risk has come true, and oil prices certainly poses some risk. But at the same time, there are some downside factors to be considered. One, the cut in GST rates. Then the hike in MSP prices for the Rabi crop is very subdued. I think it is not likely to pose some upside pressure on overall inflation. And thirdly, there could be some excise duty cuts on the petroleum products. And altogether, this could offset the rise in oil prices. At the same time, we should also not forget that the oil intensity of various countries, including India, has come down. So, I mean, the impact on inflation of increasing oil prices is not likely to be the same as we had some years back. We have renewables now. We had, very low priced solar power now. So I think that impact will be not as high as it was some years back. So I think RBI as a central bank would continue its hawkish stance, but I think in terms of rate cut, it really wouldn't transpire. They would just focus on risk as of now.
Okay, what are your 4 December, Jan, Feb, March numbers now, Tushar?
We have 3.9 for the next 2 months, and beginning early next year, we could see a reading of 4 to 4.1%.
Okay. It all, of course, is perhaps dependent on the global prices, because sometimes a sustained rise in crude price should also build into global food prices rising, because fuel works its way into everything. And this is a fund manager who spoke to us earlier in the day was worrying whether that disinflation period, even in Asia, is over. Mr. Joshi, what are you working with in terms of RBI policy?
Well, I think it doesn't look like RBI will cut rates. I think that we expect them to stay put, and unless inflation surprises them on the downside very significantly, which seems unlikely.
Okay, well then the flip question to Sajid is, if it is 5, are we seeing RBI move the other way? I mean, when is the next hike then?
No.
No.
No, I think that's premature, Lata, precisely because of the question you asked me, which is that some of this is just, well, 2 parts of this are actually one-offs. One is the HRA, which is purely statistical.
Absolutely.
And you know that next July onwards, that 40 basis points rolls off. One can even argue that to the extent that there will be a lingering GST impact. GST prices have pushed up the price level. That's why sequentially core inflation went up in July, August, September. And that also at some level is a one-off, because after a year that will roll off, unless you believe there are second-down effects from the GST. But that's hard to foresee in an economy where demand is still strong. So, you know, net of HRA, you're looking at inflation somewhere between 4.4 to 4.6. I think that's a range at which you comfortably stay on hold. Premature to think about rate hikes unless oil goes up much more, and I think no space for rate cuts, given the inflation trajectory.
So what did you say is your range? 4.6?
4.4 to 4.6 ex the HRA,
okay,
without the HRA in Jan to March quarter.
Okay. Sajid, what is your expectation in terms of crude prices? What's the global JP Morgan team working with in terms of, say, a trajectory, at least for the near term, when it comes to Brent crude?
You know, we've actually marked up our 2018 and 2019 prices quite substantially, 9 to 10%. I think the sense is that the compliance from OPEC has been much better than expected. Saudi Arabia has over-delivered, number one. Number two, let's not forget, some of this is demand. Global demands, you know, are raging at the moment. The second quarter was the strongest quarter in 7 years. And the third is, you know, and this is a surprise to some of us, that shale hasn't responded sooner. I mean, everybody thought there was this progressively lower break-even of shale, but the fact is, because oil prices were so subdued between a $35 to $50 range, number of rigs have actually reduced. So the build-up time for shale to respond could be anywhere from 3 to 6 months. So all these factors in conjunction mean that we now forecast oil to be somewhere between 55 and 60 in 2018, and close to $60 a barrel in 2019. Now, for India, you know, this is not alarming, but it's not good news. This is a partial reversal of the positive terms of trade shock we got 3 years ago. So it affects the current account, fiscal, and inflation.
The fisc. You know, this would affect the fisc because the elbow room of raising excise duties goes away. But that could come with a higher GST collection. So now, well, let me just take one more word from you. So all of you expect the Reserve Bank to be, for the foreseeable future, in pause mode, Mr. Joshi?
Yeah, that's right.
All right. Tushar?
Yes, I think given their modus operandi, this looks like the probable scenario. One point I would like to add, I think in terms of external shocks, we have seen the rise in oil prices, but we haven't seen much of impact coming through, because the other variable, that is the exchange rate, has remained somewhat stable so far. I think that might change if there's some traction which Trump's administration gained in the US, and there is some swift passage through of tax reforms in the US. And if dollar begins to appreciate, there could be some risk coming in from that angle, and I think that could be the twin tragedies if that RBI might be looking into.
Okay, but otherwise your base case is pause mode for probably the next several policies, and Sajid of course already said that. Okay, if that's it about the policy, then let me turn to the fisc very quickly. Because we have this GST rate cut, Today we got conflicting views about the fisc. In the morning, the 10-year yield was expected to touch 7%, which it almost did. And then there were reports, especially from Credit Suisse, which said that actually the GST collections were very good and would have led to a fiscal tightening. And because of the cut, it is now fiscal normalization. There is no tightening. And you saw the yields as well come to 6.96, either because of that report or anyways because of bargain buying at 7% yields. I wanted to the views of you three gentlemen on the fisc. Let me start with you, Sajid. Do you think it will be 3.5? Do you think they will borrow more, market borrowing?
No, I think let's step back and first give the government some credit. I think this is a government that's shown that it likes fiscal restraint. It likes to keep to its budget targets as much as it can. Every year when there's a clamor by markets for fiscal easing, the government has stuck to its fiscal roadmap. So I don't think they will deviate from the fiscal roadmap unless they absolutely have to. And that's an unanswerable question at this point. Have fiscal pressures picked up? They have, undoubtedly. We don't know what the GST outturns will eventually settle at. So that's the big unknown. But the fact is, you know, with oil prices going up, as you said, elbow room on excise duties has gone down. The HRA allowance this year, in our view, was not fully budgeted in. You still got a little bit of work to do on disinvestment. The excise duty cuts in October at least cost 9,000 crore. So there are revenue side pressures that have built up. My sense is that the government will try and stick to 3.2. It's left open the option. But if things come to a point in December where, you know, the nature of expenditure cuts for the next quarter are so draconian, I think then one can reasonably expect that the deficit would widen. I don't think the government would exceed the 3.5.
No, I'm more worried about market borrowing, Sajid. You know, 3.2 ultimately can be reached in other ways as well. Do you see more market borrowing? That's what you know, the way in which the calendar is laid out. After Jan 15, there is only 5,000 crore they are borrowing for the next 5 weeks, which very much looked like, you know, there could be more borrowing. Do you suspect they would do that?
I think the government has left open that option exactly for the reasons you said. 7 auctions in January and February only have 5,000 crore. Again, I think to the extent that they've got high cash balances, that will be the first course of action. And I think, again, they understand the fact that the yield curve, you know, rates have sold off 50 basis points the last 6 weeks. Again, more market borrowing will only be a absolute have to if that's the last recourse they have to, you know, they have to contend with. So again, not first choice, but don't rule it out if the revenue numbers become too compelling.
Mr. Joshi, you expect more borrowing?
Well, I think right now, I mean, predicting the fiscal is even more difficult than predicting inflation, given the GST and disruption that it has caused. But we are still working with the assumption that that central government will be able to manage its fiscal deficit at 3.2% of GDP, though there is slippage likely at the state level. So overall, I think we are working with the bond yields at 10-year bond yields at around 6.9 to 7% by the year end.
Okay, Tushar, borrowing and bond yield.
Well, I think I would agree with Sajid. I think higher borrowings would only be the second option. I think they would like to stick to the 3.2% target unless the call and the needed cut in expenditure is too much. As far as the bond yields are concerned, I think we have seen a bit of an overreaction, to be honest. I think as far as the recent rise in bond yields are concerned, I think there could be some value buying at these levels, and we could consolidate around 6.7 to 6.8% levels.
Sajid, what's your sense?
I think
Go ahead.
No, just to say, I think just the point you were making, I think a slippage of 3.4 or even up to 3.5 is already in the price. I think markets have already prepared for that. So that by itself will not lead to a bigger sell-off in our view.
Sure.
You need a slippage greater than 3.5 to worry bond markets.
Okay. Sajid, are you worried about growth? What's your GDP forecast for this quarter?
The November 30th number?
Yeah, the November figure.
So we actually see growth re-accelerating, but modestly. Our number is closer to 6.2 or 6.3%. It was reassuring to see an IP number. You know, if you look at the sequential gains, you had a very strong payback in August IP, and the September number that came out on Friday actually consolidated those gains. So I think if you look at the details, that was a good print. My sense is, you know, the bottom has been reached, but we'll re-accelerate to a level that's not above 7%. I think, again, the kind of the elephant in the room here is oil prices, because remember, a lot of the growth in 2015-16 came because oil collapsed. Now, the fact that oil prices are 15% higher will ultimately also impinge on growth. So the way I see growth is, forget about the quarterly numbers. Where are we 3 or 4 quarters from now? Some of the tailwinds here are, if global growth remains strong, hopefully exports pick up, number one, and number two, some of the drags from GST and demonetization will fade. What are the headwinds? A, oil prices, and B, the fact that you now have much more capital means you could, the deleveraging could actually accelerate.
Sajid, we want numbers.
And that won't be good for growth.
We take your explanations. What numbers are you looking for? On November 30th, what will be the number? You said 6.2, 6.3.
Yeah.
What's this year's full year number? And since you are saying next year,
6.7.
6.7 for the full year.
So for what it's worth, yeah. So for what it's worth, Lata, you should take all GDP numbers with a bucket of salt and quarterly GDP numbers with a washroom full of salt.
All right, a tub of salt.
6.3 for the quarter and 6.8. Yeah.
Okay. And Tushar, your two numbers.
I mean, the standard deviation is so wrong. The standard deviation is so high in these numbers that I think point estimates really are not particularly valuable.
Anyway, policy is not made based on them, so we can skip. But nevertheless, it's of interest. Tushar, November 30th, what may be the number announced, and full year?
Well, 6.4 for the quarter and 6.7 for the year.
Okay.
And Mr. Joshi?
We are a bit more optimistic. We are working with 6.5 for second quarter, and 7% is our forecast for the full fiscal year as of now.
All right, gentlemen, thank you very much for joining us with your thoughts on inflation, on fiscal deficit, and on the growth number that's going to be announced on November 30th. Well, let me just summarize. The inflation number has come in a tad higher than what we were expecting. It's the Ekta's poll had thrown up a number of 3.5. It's come in at 3.58%, and a large part of the blame would go to food, because food prices have distinctly gone up to 1.9% compared to 1.25 last month. As well, of course, there is a jump even in HRA, which again was largely anticipated, and therefore the housing index has distinctly moved up to about 6.68%. Services inflation, which is largely non-food, or what you call core inflation, non-food, non-fuel inflation, is still ranging at 4.6%. That is a tough number that's not coming down, and that's the number that RBI watches very closely for its policy decisions. For the rest of the year, Sajid is most hawkish and believes that we could end up with a last quarter inflation of between 4.8 and 5. The numbers from Mr. Joshi of CRISIL more benign at 4 to 4.5, as well from Tushar of HDFC more close to about 4.2, 4.3 is the inflation for the end of the year. None of them expected the Reserve Bank to move at all. Only on bond yields, there is a bit of a worry that the government may borrow more, but if it is a 3.5% fiscal deficit, then that's largely baked in. That's the word coming in from our experts. From me and Ekta, thank you very much for watching this special broadcast on the macroeconomic numbers that have just hit the screens. But do stay tuned in. More news and analysis follows on CNBC TV18.